Hello, Gary here, and today I want to talk to you a little bit about landlords, portfolio landlords, tax, SPVs, and the implications of these types of things. I've been seeing a number of inquiries, questions, and I think really there's quite a few landlords that are burying their head in the sands at the moment, or potentially don't know what is coming in the next 3 years, or actually in the next 2 years. You know, by April 2020, there's huge tax changes coming, and particularly for portfolio landlords. Now, some of you may be beginning on your property journey and you may be wondering, well, what is a portfolio landlord? So if you've been in property a little while and you own more than 4 properties, as soon as you purchase the 4th property with a mortgage, you are classified as a portfolio landlord. And what that means to you is that you need to have your whole portfolio needs to be less than 75% of the property's value. And what that is going to mean for you when you come to look at purchasing new ones, when you come to look at refinancing, when you come to look at getting better deals, you know, buying additional properties, is some mortgage lenders in the UK are going to require additional information from you. Something, you know, some lenders are going to require a full-blown business plan in terms of what you want to do and what you want to achieve and what your future looks like. Some are going to want assets and liability statements going into this. You know, they're really going hard on the amount of documentation that you're going to need. Some lenders are going to limit the number of properties that you can have with them. So there's 2 types of options in these scenarios. As you start to buy more property, you can potentially look at a portfolio mortgage. So we've got a client at the moment who is remortgaging a number of properties, and we're assessing whether it's better to look at each property on its individual merit and remortgage each property individually, or whether it's better to go for a portfolio mortgage. And what is the advantage of a portfolio mortgage? Well, he's remortgaging one, but in remortgaging one, the lender is looking at the whole portfolio, and they're actually pre-agreeing a set limit that he can borrow up to. And what that's going to potentially mean for him is less fees to pay. It's going to make it easier for him to buy in the future because they're looking at his full-blown circumstances and everything at the present time as part of that one property that he is remortgaging. So that's a little bit around portfolio landlords. What I now want to touch on is the big tax implications for anyone who is potentially got quite a lot of property at the moment. Now, they're coming into effect majorly. You need to know what's going on by April 2020. And effectively, the government is removing tax relief on the interest-only mortgage payments. Now, what does that mean? Well, up until recent times, and within my 16 years of doing mortgages, you know, in the early stages, if you were receiving £1,000 in rent and your mortgage payment was £500, you would only pay tax on the £500 difference. However, as a means to slow down the buy-to-let market and because of previous budget changes, they've ultimately changed those laws, and that's being capped at 20% for anyone who owns property individually in your individual name. So as a basic rate taxpayer, that's going to potentially simply mean that your accountant's going to charge you more because you're going to have more professional fees, but it's unlikely that it's going to affect your profit. Good news. As a higher rate taxpayer, you could see some major effects. So you're no longer going to be able to claim the tax relief at the marginal rate. You're going to get 20% tax credit, and it's going to be capped at 20% as a percentage, which means that it could affect your profit and loss. So you could, if you're a higher rate taxpayer, see major effects on your company profits. If you're a basic rate taxpayer at the moment and you're on the cusp of becoming a higher rate taxpayer, then you are potentially going to see an increase in your tax, and it's going to be hitting your profit as well. There's also a change in the wear and tear allowances that are going to be affecting landlords. Instead of being able to claim 10% of your rental income, they're now making it only possible to claim your actual expenses. Now, I am a mortgage broker. I've been a mortgage broker for 16 years. So I would recommend that you speak to your tax professional, your tax accountant. I want to stick to mortgages, but that is certainly something that you need to sit down and you need to have that very important conversation about how these tax changes are going to be affecting you, your portfolio, your properties, and your future strategy. Now, how will it affect? As I've said, it's going to reduce your property. It's going to reduce your profits, sorry. So how's it going to affect you? It's going to potentially reduce your profits. Now, what does that mean for you as investors, as people who want to buy property going forward? Well, it's going to mean that potentially a lot of landlords, particularly if they own a lot of property, are going to be reassessing their strategy. And there could be some win-wins in this. Now, the first thing that a landlord is going to potentially consider, and you may wish to consider as a landlord, is to increase your rent, because that can potentially offset the tax and the loss in profits that you're going to have. The second thing that you may wish to consider is refinancing your portfolio. The number of people that I see at the present time who aren't consistently looking at their portfolios and paying what is called the lender's standard variable rate, thus paying far too much for the mortgage, that's affecting your profit. So we might see a lot of refinancing coming up. Now, the next two that you guys are going to like, because it's going to potentially see a lot of landlords who are going to be exiting the mortgage market or exiting their strategies, which ultimately means there could be some deals available. And there could be landlords who are going to potentially sell their portfolios, which means that you might be able to buy a whole portfolio. So there could be some opportunities around about 2020 to pick up some superb deals, with landlords with big portfolios that potentially want to offload those. Now, the income tax liability could affect the amount that you're going to be able to borrow. So the way in which buy-to-let mortgages are assessed is basically upon the rental income that the property receives. It's not so much taking into account your actual own income. So what that's going to mean is if you've got an increased tax liability, that could affect the amount that you're going to be able to borrow based on the rental income that you're actually going to be receiving. I hope this is making sense. So, what I have seen over the last 3 years, since 2016, 2017, a massive increase in the number of people who are looking to buy properties within limited company SPVs. Now, my niche and a lot of the people that I look after are limited company business owners, sole traders, self-employed individuals who want to use their company profits to invest in property. So this is why I see quite a lot of this scenario around using limited company SPVs. So if you're a higher rate taxpayer, you could benefit from buying your property in an SPV, because under an SPV, you have no income tax on the rent. You have no income tax on the rental income, which could save you money. As a limited company, you're only going to pay corporation tax, which is currently set at 19%. So you could see some savings on your tax liabilities, and you could see more profits being available to you. The other good news is that you can offset the mortgage interest against the whole portfolio and against the limited company. So as this is being restricted, as I mentioned, for individual people by 2020, if you're within a limited company, you're going to potentially be able to benefit from offsetting those mortgage interest rate payments. Win-win. Now, the tax burden that you could have could also be reduced, because when you own them personally, that is going against your personal tax liability. When your profits are within a limited company, you only pay the tax on what you withdraw out of the limited company. So you're going to pay corporation tax, but if you choose to leave the profits in the SPV, you're not going to pay dividend tax, you're not going to pay personal tax, thus it could be more beneficial to you. And one thing I massively advocate, because my market is business owners, those profits that you leave in your property portfolio could potentially be used to assist you in buying your residential home. If you were to approach most of the mortgage lenders on the high street, they're going to generally want to see salary and dividends. However, through my own personal experience, which is what made me niche my business back in 2015, there is a huge number of lenders that would consider potentially your net profit plus any salary that you draw out from your limited company. So if you've got a big strategy of buying property in an SPV and leaving the profits in there so you can keep further investing and growing your portfolio, that could be a massive advantage for you. Now, however, there are some howevers when buying property in a limited company SPV. Not everything is all full of roses. As a limited company, when you buy the property in there, it doesn't enjoy capital gains tax personal allowance. So you could end up paying if and when you choose to sell potentially in the future. You're also going to find that your accountant's fees are likely to be higher because in having a limited company, you have to have formalised accounts that are submitted to the Inland Revenue, to the HMRC, to Companies House, and thus that could see your accountancy costs going up year on year. Also, if you want to move your, or something to consider in fact, is if you own the properties personally at the present time and you want to move those properties from your personal name into a limited company SPV, you're going to potentially find, well, the first thing you're going to find is you're going to have to pay stamp duty again. So that's a massive, massive cost and a consideration. And there's a possible chance that you might have to pay some capital gains as well. Now, as I've already said, I'm not a tax specialist. My goal is as a mortgage advisor. So I'm giving you a baseline bit of information here. This is not constituting advice. This is just information for you to go and speak to the relevant professional. If you want mortgage assistance, that's my bag. So with mortgages within a limited company SPV, what you are going to find is it's ultimately your decision whether you choose to buy personally or whether you choose to buy within a limited company. So I would massively speak to your tax professional, speak to your accountant. But what you are going to find when you look at getting a mortgage for a limited company SPV, although the number of you guys and business owners and investors who are buying in SPV, there is still a limited number of lenders available who are willing to consider that circumstance. So it could be that you would pay more for those. You generally see higher interest rates at the present time, and you also find that the arrangement fees that the mortgage lenders are charging are also higher. So you need to get some accountancy and tax advice. What I generally find with my clients is that it's going to depend on your finances, it's going to depend on the number of properties, it's going to depend on the number of mortgages that you have, and it's going to also depend on the exit strategy that you have for your portfolio, for your lifestyle, for everything that you want to achieve, your legacy within property. So I hope that makes sense. A little bit of coverage there in terms of being a portfolio landlord, what taxes are going to affect you. If you're a higher rate taxpayer, then an SPV could potentially be the right route for you, but you are going to find some downsides in and around buying in an SPV as well. But 2020 is the date, so you need to start making plans and also thinking about that now, because you don't want to be one of the millions of people who's going to potentially be shocked by a massive loss in profit because of the tax changes that are coming into effect. So make sure you find out how that's going to affect you. But also in doing the research for this information that I'm giving you now, I thought I'd end on a positive note with some fun facts. Because when I'm looking at lenders' websites and collating all this information, would you believe presently within the mortgage market, 66% of landlords are men, which means that 33% of you are women. Also, I found that over 49% of landlords are over 55. 40% are between the ages of 35 and 54, which is my category. And then 11% are between 18 and 34. So certainly I think the 11% as well, from looking at the research, is actually growing because more people are starting to see the benefit of building property portfolios. And actually the numbers that I looked at, I think it was 63% of people were in full-time employment building their property portfolio as well. Something that you might be interested in and is massively advocated when thinking about property, you know, having your gold mine area surrounding where you are living. 72% of people still buy property in and around the region in which they live, which means that only 28% are going further afield. You know, I'm based down south in Essex, and property yields here and the size of deposit that you need is quite substantial. So a lot of people are going up north when thinking about buying or investing, but it's good to see that 72% of people are still buying in their own region. And in terms of the future, I found that 37% of people who have landlords who have portfolios are actually wanting to pass them on to their kids. They're building the legacy for the next generation. 22% are literally doing it with a view to sell up and provide for their retirement. And the good old honest 22% who have absolutely no idea what they're doing. And they're entitled to do that. I'm sure they'll make some decisions in the not too distant future. So remember, if you are a landlord or a portfolio landlord, 2020 is the deadline date. As investors and people thinking about their property strategy, there's going to be potential people selling up their portfolios, or landlords selling up their portfolios, landlords exiting the market, which could find that you might be able to scrap up some below market value deals or potentially pick up some cheap portfolios. So as investors, as landlords, 2020 is the date where you need to be thinking about, but you need to start taking action on resolving these issues and finding solutions as soon as possible. Speak to your accountant, speak to your tax specialist. Thank you very much. My name's been Gary Das. I hope this has been useful. And as I'm in the mortgage industry, your home may be repossessed if you do not keep up repayments on your mortgage. None of this is constituted advice. It is for information only purposes. And should you wish to obtain a quotation, then you just need to speak to a mortgage professional who can do that for you. Thanks very much. Have a good day, and I shall see you soon on another video for you guys. Let me know any thoughts, questions, queries in the comments below.